Hello, and welcome to Virtual Investor Conferences. My name is Matt Lateplo, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from NVLPF Health Corp. Please note you can submit questions in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I'm very pleased to welcome Chris Dobbin, President and CEO of NVLPF Health Corp, which trades on the OTCQX Best Market under the symbol NVLPF and on the TSXV under the symbol NLH. Welcome, Chris.
Very much, Matt. Appreciate you having me today. I'm going to assume that there's two groups within the audience. The first being a group that's probably followed the story or knows us pretty well over the last few years. And the second group, perhaps, that's new to the story and wants to learn a little bit more. And so I'll try to balance out the presentation based on those two groups. The presentation, I guess, today's session will be broken up into sort of two parts. The first will be covering the corporate presentation that's available on our website. And the second part will be probably my favorite part of the presentation, which is the Q&A at the end. So I encourage those that do have questions to submit them during the course of the presentation, and I'll cover them off. So we'll probably save about 10 or 15 minutes just for Q&A at the end. But that's usually the part that I look most forward to. So I'm gonna start with probably the investment highlights, just in terms of why I think it's important for people to keep a close eye on our company, and I'll get into exactly what we do. And I we got a list of things there, but I sort of looked at, from my own perspective, how I view things. And the first is, one, we do produce cash at the operating level. So I think that's number one, it's important. Two, we are virtually debt free. So we've paid off all of our bank debt. We have about $120,000 left of promissory notes from previous acquisitions that we made. So virtually debt free. Virtually no CapEx whatsoever. I mean, we may buy some computers during the course of the year, or we have two vehicles that we might have to do some maintenance on. But for all intents and purposes, no debt and no CapEx. We are in an industry that I think everybody understands. We provide in-home care, and it's an aging demographic. As much as people debate on a lot of topics these days, I haven't heard too many folks, indicate they don't believe that we actually have an aging demographic or an aging population. So I think our industry is very easy to understand from that perspective. We have grown our company through acquisitions primarily. We plan on making a number of acquisitions in the coming years. And I think it's important for people to understand that my belief is there will be, hundreds of opportunities for us acquisition wise, in the coming years. Just, we have a pipeline of opportunities. We regularly meet with owners that have started the business years ago. They're looking for an exit, and we think we're a pretty good acquirer. We do have about 40% insider ownership. And for those that have followed our story for some time, you'll know that insiders have been active buyers in the open market, on a pretty regular basis. And, we're trending at roughly 1.7 million US of EBITDA, or in Canadian dollars, equivalent about 2.2 million for those that are listening from Canada. So, and coming off two record quarters. So really a company that's really, really well positioned from my perspective as we enter into 2024. So having said that, what do we do as a company? Again, we're primarily in what we call the in-home care space. And so think about, and primarily in the non-medical side. So we go into a senior's home, like with their own residence primarily, and we provide dementia care as being our number one service. About 75% of our clients live with some form of dementia. But think about it as activities of daily living. So this could be, anything from mobility issues, helping a senior get around, his or her apartment, bathing, personal groomings, errands, light housekeeping, doctor visits, anything really to make someone more secure, within their home. And if you think about it, we often talk about the sandwich generation, where you have adult children that are looking after their own kids, and they know they have mom or dad or a loved one that needs some assistance as well. And so that's often why we're actually called to come look after somebody within their own home. Now, we also provide one-on-one care within facilities like assisted living or nursing homes, again, primarily where they have what they would consider to be a resident or patient that has dementia. They would call one of our agencies in. We would provide the one-on-one dementia care within that type of facility. But our primary service is generally within the home. There is the concept of home health care, which people often refer to as the skilled side, which is the nursing side. We do some of that, not nearly as much as on the non-medical side, but certainly we see some avenues of growth in that area, and we've pursued some of that over the course of the last year. Important for those that are listening from the US, we're not in the Medicare or Medicaid space. So, and in Canada, we're not in a government funded space, like aside from veteran affairs. So we do accept veteran affairs insurance coverage. We do accept long-term care insurance coverage. But our primary mode of reimbursement, if you will, is really direct out of pocket from the seniors we provide service to or their adult children. So it's an out-of-pocket expense for us to come into their home and provide the service that we do. Again, so think about us as private pay as opposed to government funded, because we'll talk about the pricing power that we have a little bit later on. Again, I'm not going to spend a lot of time on the industry itself. I think, if you understand that we have an aging population, and if you've been, affected in any manner whatsoever by a loved one having, health issues within their home, that's kind of where we come in. And generally the population we serve is 65 plus, and even 70 to 75 plus often. But, the reason that's a bit of a trigger point is that there's a 75% chance you'd have at least one chronic or long-term condition when you obtain the age of 65. So it's as simple to understand that, generally as people age, they have some form of health issue. It's a health issue that leads to the need for care within a home, and that's where we come in. So we've grown primarily from acquisition. So our head office is based in Halifax, Nova Scotia, Canada. We have operations in 10 states right now. Anywhere from the northeastern part in New Hampshire, Massachusetts, Rhode Island, down to the eastern seaboard. We do hit South Carolina. We're in the Midwest in Kentucky and Ohio. And then we sort of jump over to the South Central region, Arkansas, Oklahoma, and Texas. So, we've made a number of acquisitions over the last few years, and we'll sort of talk about what we look for. So generally, the acquisitions we've made and sort of what we look for going forward, we look for a business that has a track record of around 10 years, and historically profitable, a good office team. So if you think about what we're actually acquiring, you generally have an office staff, which could be 2 or 3 or 4 people, depending on the size of the organization. We have some that are larger. And then there may be 50, 75 caregivers in the field, so in people's homes or within a facility. And so there's usually a rented office. So we would pay rent for a small rented space where our office team would be, and then the work again is done out in the field. So, we don't need to own a whole bunch of buildings. We don't own facilities. That's why I mentioned it in the summary at the beginning that we have very little CapEx. So it's really a pure service-based industry where we utilize the infrastructure of those that we serve. Really, that's probably the best way to look at it. We really have a 2-pronged approach in terms of how we plan on building out our acquisitions. If I go back to the map, really these areas, so up in New England, we would consider to be an area, the Midwest, and then South Central as well as Nova Scotia, those sort of the primary areas. Our plan is to really continue to make acquisitions and grow organically within those areas. There's lots of opportunities for us to grow in the coming years, just within those areas alone. And it works well for us just the way that we've set up our management models. We have regional directors that look after a number of agencies. And so we don't have to add a whole bunch of people as we make another acquisition. We already have the infrastructure in terms of management people, technology, and premises in place. And so it makes a lot of sense for us to continue to go deeper within those areas. So our growth strategy, I'll talk about 2 of them primarily. I mean, organic growth, you should think about in a couple different ways. This can be an increase in hours, and I will talk about what we plan on doing probably at a later date as I update folks for 2024, just in terms of how we plan to increase hours. Because again, we bill on an hourly basis. 2, pricing power increases. And so we operate in an inflationary environment. And if you think about that, what that means, often there's an increase in wages. And for those that have followed us and for those that are new, I mean, you'll see that if you to go back and look at where we were from a gross margin percentage, we were usually in around a 33% gross margin pretty consistently for a number of years. And we've been up in around the 37. So our gross margin percentage has actually increased over the last probably 24 months or so. And again, that's because of the pricing power that we have, which has been good. And again, I sort of differentiate that between the Medicare and the Medicaid space, which you'd be impacted in a very different way. The other way to think about it is opening new locations. We're always considering that, but that's not been our primary way of growth, and probably will still not be our primary way to grow going forward. And I'll talk about why in a bit. Acquisitions, we've made a number over the last few years. At one point, up until the end of 2021, we were averaging about one per quarter. We were definitely impacted by COVID, and I'll show the financials in a bit. We've come out of that with record results, and so we're back in acquisition mode. Joint venture partners, something that we think about on a regular basis. Quite honestly, we haven't found any JVs to be of interest to us at this point, but I keep it on there just because folks should be aware that we're always looking at different initiatives. So this is our financial profile. You'll see, we really started back in 2016, and so we had fairly significant growth up until we were impacted by COVID. On a quarterly basis, we had record revenue, record EBITDA. Definitely were hit by COVID as schools shut down primarily, a little bit less access to caregivers than we would have liked. And so that didn't allow us to have as many hours as we would have liked. You'll see on the right-hand side in the quarterly adjusted EBITDA, we were coming off two record quarters. So I generally put out some CEO commentary with each of our quarterly results. And I spoke all the way through 2022 and 2023, just on some of the changes that we've been making, and those have really panned out for us. And so from my perspective, we've really set a new base for where we are from an adjusted EBITDA perspective. So when I talk about, us trending right now at about 1.7 million of adjusted EBITDA in US dollars, that's really where we are. That's our new base. And again, equivalent would be about 2.2 roughly in Canadian dollars. So, my expectation is that we'll continue to build upon the base that we've set the last couple quarters. And that's really what our focus is on in 2024, both building upon our existing operations as we've demonstrated over the last couple quarters, that we can continue to make improvements there, and then overlaying M&A in addition, because we have no debt. That's really the plan for 2024. So we have a couple of us at head office. So Chris and I really run the business from Halifax. And I say run the business, we keep an eye on things. We have our full back office functions with accounting, billing, payroll up in Halifax. We have a team, I think, of eight folks up here in addition to us, 7 or 8 now. And we have, great operators in the U.S., a terrific VP of operations. So very well suited from an operational perspective, within the U.S. And so well set up and sort of well-established personnel as we enter into 2024. Our board of directors, I'm on there, and then we're surrounded by 5 other independent directors, all with varying degrees of public company, private company, entrepreneurial, executive experience. And so, everybody's sort of CV or background is there for you to view, if you want to download the presentation from our website. Our cap table, roughly 86 million shares outstanding, fully diluted about 93 million. We've got a market cap. I think we'd submitted this a couple of days ago. I think the market cap is probably around 22 million Canadian right now. Probably still around 18, I would say, in US dollars equivalent. I think our stock price on the TSXV is about 25. I think it was about 19 last I checked on the OTCQX. So not far off from the numbers that we have. We do have one analyst that covers us. We used to show on the bottom left-hand side our debt, our bank debt, but again, we've paid that off as we indicated that we would in my Q3 commentary. So we don't have any long-term debt aside from $120,000 of promissory notes remaining from one of our previous acquisitions. So, in a really, really good spot. So again, I just sort of want to go back to my summary before I take Q&A. So from my perspective, we're generating, cash from operations, which is a great thing. We have virtually no long-term debt, again, from $120,000 promissory notes we have. So it's, virtually long-term debt free. We have no CapEx. We have an aging demographic, huge opportunities in front of us from an acquisition perspective. And we can pursue those acquisitions because we actually have access to financing through new debt, right, which is important. And I think for those that are trying to make some, estimates going forward of how many acquisitions we could do, or how much leverage we could employ, or what that buys us in terms of revenue and EBITDA and so on. I think the best thing to do is probably go back to all of our previous announcements, and you can probably take a look at, for every dollar that we invest in a company by way of acquisition, how much revenue that will buy, or how much EBITDA that could generate, to sort of make some projections on your own. We don't tend to put out, any guidance from a financial perspective, but the one thing I think you would find from us, particularly if you've been around the story for some time, is that we're pretty consistent in terms of how we buy the businesses. Pretty consistent in terms of how we pay. I mean, we've generally paid between 3-5x of EBITDA. A couple occasions we've gone above that where it's made sense. But usually, again, pretty consistent. How we funded the deals has been pretty consistent. But the advantage we have right now is that we're coming off record results, record EBITDA, and no debt. And so we do have borrowing capacity, which allows us to do some deals going forward. So, insiders, again, continue to acquire shares in the open market. For those that want to look at those, you can look at the SEDI filings, which are pretty easily accessible. We've been pretty good at supporting our own stock within the market, basically because we think it's a great long-term investment opportunity, and so we're happy to buy it at the prices that have been presented to us in the market. So, if people think that thing, I certainly do, and I've talked about this in public before. We kind of put our money where our mouth is. So, we believe in the long term of the company. We think we're in a terrific spot. We think 2024 is going to be a great year for us. So, with that, let me sort of look over at the questions and get into some of the Q&A and see if I can answer some here. Okay, so first question: what's the reason your business in the U.S. is doing better than in Canada right now? So I think that's just in reference really to the last couple of quarters. Our Canadian operations last year in 2022 had set record results for us. We've had a bit of a downtick that, from my perspective, is temporary. But the U.S., I would say we had really been hit hard during COVID, as you would have seen in our quarterly reports. And again, in my commentary, I had indicated that we'd put a huge emphasis on getting those things turned around in the U.S. And we've obviously done that. I think our adjusted EBITDA in the U.S. is probably up 2.5 times over the last 18 months or so. So, terrific turnaround for us in terms of how things have panned out. So from my perspective, going forward, two things we can do. One is we continue to build upon the excellent results that we've shown in the U.S. There's still definitely room for improvement there. And again, I think the results in Canada, a bit of a downtick, are temporary, and so I expect those to come back as well. Second question: is there a focus area, region in the U.S. who is doing better than others? If yes, why? That's a tough question to answer. I wouldn't say necessarily by geography. If you think about what we have, there's a bit of a portfolio effect, I guess, to some extent. Like, we have a portfolio of home care agencies, and in any given month, one agency could do better than another. It's not by region. It's really agency specific. So if you think about a really tiny agency that we have, if we get a 24/7 client, then that could have a huge potential upswing. Likewise, if we lose a 24/7 client, that pass away or whatever, then that also has a huge swing to the downside. So some of it's just agency specific in terms of the size that they are, but I wouldn't really say geographically. I wouldn't go by geography in terms of how we did earlier with sort of the New England, Midwest and South Central. It's more agency specific. Next question: do you generally charge more per hour today than when you started around 2016? Yeah, I'd say we do. I mean, again, I talked about the inflationary environment that we're in. I mean, we have to pay our caregivers more, which we're happy to do. And as a result of our pricing power, we've passed those on to clients. So yeah, for sure. I think pretty consistent across many industries these days. We've adapted, I think, pretty well, which is why you've seen our gross margin percentage go up. Next question: how does the caregiver situation look today in Q4 compared to Q3? Yeah, look, I've talked about this, the last couple of quarters, and it's a lot. It's getting better. It's a lot better than it was a year ago, and so it's really the main reason in terms of how we've been able to sort of turn things around in the U.S. as well as we have. It's been access to caregivers, great caregivers. That's what we need. I mean, our business is reliant upon that. So, is it where we'd want to be in terms of having as many caregivers as we'd like? Definitely not. But we've seen huge improvements over the last few quarters. Can you speak to the skill set of your caregivers? Any issues in staffing for growth? Well, I think I just alluded to staffing for growth. We'd certainly like to have more caregivers. Caregiver training for us is extremely important. I mean, you have folks that have different backgrounds, and we hire RNs, LPNs, CCAs, personal support workers, PSWs, folks that have grown a family that are looking to give back. This is meaningful work for them. So a bunch of different backgrounds, really. But if you think about the comment I made earlier, 100% of our client base lives with some form of dementia. That's our target market. I mean, we really are a company designed to help families that have loved ones that live with dementia. I mean, it's how I started the business back in 2016, and it came out of a personal family situation. I mean, this was a situation where my father-in-law, had Parkinson's, and I didn't know anything about home care at the time, and I didn't know anything about dementia at the time, to be frank. And it was a huge learning experience for me. We benefited from home care the last couple of years of his life, and one of the things that we noticed is we had, as much as the people that were coming in providing the service were really, really nice people, and they were. There was a bit of a lack of training, and so one of the things that's always important to us in having gone through that situation and really trying to build out a business that's meaningful for families, and the work that we perform is making sure that we provide the dementia training. And so, we do that. And when I go around and I visit our offices and I talk to our caregivers, I mean, it's the number one issue they appreciate. It's just, they appreciate when we provide training that allows them to build their skill set to be better within a home. I mean, that's kind of how it works. So great question. Can you speak to your acquisition model and plans for 2024 and how you finance? In terms of model, you probably go back to the last 19 acquisitions we've done. They've all been announced. Is probably the best way to look at it. I mean, generally, and I'm not totally sure if you're asking about, sort of deal structure or something else there, but the way we've structured the deals in the past, if you are a seller, you're generally getting cash up front. We're always getting some form of cash up front. And there's generally been some combination of promissory notes or an earnout or some, definitely between those two buckets. So there's some deferred payments and there's some cash up front. From our perspective, for 2024 and how we finance, again, I've alluded to the fact that we're a company generating about 1.7 million in annualized EBITDA. We have no debt. So, we have access to borrowing that allows us to do some deals for 2024. How is currency impacting your bottom lines? Do you hedge in any way? So I would say the currency is impacting us only from an accounting perspective. I think this is important. If you take a look at our income statement, they call it now a statement of earnings and so on, you're going to see there's a foreign currency gain or loss every quarter, but that's really it's not a true translation. I mean, it's only done for accounting purposes, right? Because we have operations that exist in Canada and the US, and we report in US dollars. We're not actually taking, US cash and translating it to Canadian dollars or vice versa. So it's simply done for accounting purposes. And the way that we've done a bit of a natural hedge in the past has been when we make acquisitions in the US, then we usually get US denominated debt. Or if we make acquisitions in Canada, it's Canadian denominated debt. So it's a bit of a natural hedge from that perspective because we're not actually moving money back and forth between Canada and the US. I mean, very, very little. So any FX impact is really from an accounting perspective and really nothing more. Next question, do previous owners stay on to manage the local business? Not generally. Not generally, but it's a great question. I'll sort of answer this in terms of how we look at businesses. The first bucket is really succession planning. So these are owners that have started the business 10 or 15 years ago, and they're looking for an exit, right? So just purely succession planning. And so in those cases, the owners don't stay. Now we look to make sure they have a great operating team, and it's important to us that we can actually elevate somebody within the current office. We probably do that about 75% of the time. The other 25% we may hire externally, but our preference is to hire and promote within. We really enjoy doing that. But that first bucket is purely succession planning. They're looking for an exit. Now, the second bucket that we would look at, and we haven't done any deals this way, so for whatever reason, we haven't found the right opportunity, are for owners that are looking to expand their business within the state, within a larger territory, however it is. Again, we're not franchised, so I just carefully use the word territory, but geography, I guess, is probably a better way to put it. If there's someone that's looking for a partner and that can provide help with strategy and financing and back office functions, those are opportunities we actually look for. And we've had some discussions, again, just haven't had the right opportunity to consummate a transaction. But those are the two buckets: succession planning, where the owner's looking to leave, and then the second bucket where someone really needs some assistance and we can provide that, and they're willing to stay on and grow the business. Yeah, and again, they have to want a partner, though. It has to really be a good fit. Like they have to want to do that. Next question: milestones and growth drivers for 2024. Yeah, I mean, look, two things for me. One is you've seen obviously really improved results from our current operations. I mean, it's quite evident in numbers. Q3 and Q4 were record results for us, and so the first is to continue to make improvements in those businesses, and I think we can continue to do that, and that's a huge priority for us in 2024. And then the second thing, as I've alluded to, getting back and making acquisitions in 2024. I mean, we plan on doing that. We have the capacity with having no debt to be able to do that. And so I think if you mirror, continued improvements, we can execute on that. And if we can execute on getting back in M&A and having some good transactions there, then I think I think we're really set up well for 2024, which could be a great year for us. So I think I have hit every single question that I see there, and we have about 2.5 minutes left, so finishing on time. Look, I really, really appreciate everybody that's joined in the call. For those that are followed us along for some time, appreciate that you've stayed with us, and for those that are new to the story, I appreciate you coming on and having a look. And hopefully, I've done a decent job at least laying out the opportunity that exists for investment in Nova Leap and what I think can be a great year for 2024. So very much appreciate everybody's time and wish everybody a great day.